something unusual is happening in the Northeast housing market. It's not loud, it's not dramatic, but it is unmistakable. Homes are piling up, not crashing, not collapsing, just waiting. Waiting longer than they used to. Waiting through open houses with fewer visitors. Waiting while sellers check their phones again and again. Inventory is rising. And for a market that thrived on scarcity for more than a decade, that change matters. Pause. Because the Northeast was never supposed to look like this. For years, this region played by different rules. New York, Massachusetts, New Jersey, Connecticut, Pennsylvania, dense cities, old neighborhoods, limited land. Everyone believed supply could never truly catch up. And for a long time, that belief was correct. After the 2008 financial crisis, construction slowed to a crawl. Builders pulled back. Banks tightened lending. Local zoning boards resisted density. The result was simple. Too few homes. Too many buyers. By the mid-2010s, the Northeast had become a market defined by competition. Multiple offers. Waived inspections. Bidding wars before the first open house even ended. Scarcity wasn't just a condition. It was the strategy. Then came 2020. And everything accelerated. Interest rates dropped to historic lows. Remote work untethered people from offices. Suddenly, space mattered more than proximity. Families fled small apartments. City dwellers searched for yards, basements, extra rooms. The Northeast absorbed this demand almost overnight. Prices surged. Listings vanished. Days on market collapsed. It felt unstoppable. But underneath the frenzy, something else was forming. Quietly, patiently, inventory was preparing to return. Here's the thing about housing markets. They move slowly. Until they don't. Decisions made years earlier begin to show up all at once. And the Northeast made several critical decisions, strategic ones, that are now reshaping the landscape. Start with construction. For decades, the Northeast lagged behind the Sun Belt in new housing supply. Regulations were stricter. Land was scarcer. Approval timelines stretched for years. But after 2020, something changed. Municipalities faced pressure. Renters were angry. Prices were politically impossible to ignore. So cities began approving projects they once resisted. Multi-family developments, townhome clusters, transit-oriented housing. Not everywhere, but enough. Those approvals didn't matter immediately. Construction takes time. And now those homes are arriving. At the same time, demand began to cool. Not disappear. Cool. Interest rates rose. Monthly payments doubled in some cases. Buyers hesitated. Suddenly, urgency faded. The same house that would have sold in 3 days now took 3 weeks. Then 6. Then more. And listings started stacking up. This is where inventory becomes powerful. Because inventory changes behavior. Sellers notice first. They see competing listings down the street. They check price reductions online. They start asking uncomfortable questions. Should we wait? Should we lower the price? Did we miss the peak? These questions didn't exist 2 years ago. Now they're everywhere. Historically, the Northeast has been resilient. During past downturns, prices here fell less and recovered faster than much of the country. Why? Jobs, education, finance, healthcare. Stable industries created stable demand. But stability doesn't mean immunity. And inventory is the variable that even strong markets can't ignore. Look back to the early 1990s. The Northeast experienced a slow, grinding housing correction. Not a crash, a stagnation. Inventory rose. Prices went sideways for years. Real values quietly eroded through inflation. Homeowners didn't panic, but they also didn't build wealth. That's the kind of shift inventory creates. Today, the signs are familiar. More active listings. More price improved tags. More homes relisted after failed sales. Not chaos. Transition. And transitions are where power shifts hands. Buyers gain leverage. They negotiate again. They ask for repairs. They walk away. Sellers lose certainty. They adjust expectations. They compete on price. They offer concessions they once refused. This is not theory. This is how inventory works. And here's the most important part. The inventory increase isn't happening everywhere equally. Urban cores behave differently than suburbs. Luxury markets respond differently than starter homes. Condos react differently than single-family houses. The Northeast is fragmented, which makes this shift harder to see, but more dangerous to ignore. So what caused inventory to explode now? Not one factor. Several. Higher rates. Delayed construction. Aging homeowners listing properties. Investors stepping back. Migration patterns stabilizing. All of these forces converged. And convergence is how markets turn. This doesn't mean prices will collapse tomorrow. It means the rules have changed. The Northeast is no longer a one-direction market. And when a market loses its direction, opportunity and risk multiply. It never has. It never will. Some places feel it early. Others feel it late. And a few don't feel it at all until suddenly they do. The Northeast is entering that phase now. A phase where the map matters more than the headline. Start with the cities. Boston, New York City, Philadelphia. For years, these markets absorbed demand effortlessly. People came for jobs, culture, universities, and opportunity. But cities depend on movement. And movement has slowed. Remote work didn't kill urban demand, but it rewired it. People no longer needed to live near offices. They needed to live around life. Space, quiet, flexibility. That shift pulled demand outward. And when demand moves outward, inventory builds inward. Look at condos. Condos are always the first to feel pressure. They share walls. They share fees. They compete directly with each other. When new condo buildings open, listings don't just increase, they collide. In cities like Boston and New York, new units are hitting the market alongside resale condos. Same buyers. More options. That's how inventory explodes quietly. Now move outward to the suburbs. This is where things get interesting. During the pandemic boom, suburban Northeast markets went vertical. Westchester County, Northern New Jersey, Long Island, Greater Boston suburbs. Prices jumped faster here than in the cities. Why? Limited supply, family buyers, emotional decisions. People weren't comparing spreadsheets. They were escaping apartments. But suburban supply has a delayed reaction. Homeowners don't rush to list. They wait for signals. Those signals are arriving now. Empty nesters, retirees, owners who refinanced years ago but now want liquidity. They're listing, not all at once, but steadily. And suburban buyers facing higher rates are slower, more cautious. That gap creates inventory. Then there's the luxury market. This is where inventory growth accelerates fastest. High-end homes rely on confidence. When buyers feel uncertain, luxury demand freezes. Not declines, freezes. Sellers stay firm on price. Homes sit. Inventory stacks. The Northeast luxury market is already showing this behavior. Now let's talk about the overlooked group. Investors. In the late 2010s and early 2020s, investors quietly entered Northeast markets. Not flippers chasing headlines. Long-term rental buyers. Small multifamily. Condos near transit. Single-family homes in strong school districts. Low rates made the math work. High rents sealed the deal. But higher rates break that math. Cash flow shrinks. Returns flatten. Risk becomes visible. So investors pause. Some sell. And when investors sell, they don't wait forever. They list. That adds supply without adding demand. Inventory doesn't need panic to grow. It only needs hesitation. Now zoom out. Population trends matter. The Northeast has slower population growth than the South or West. That was manageable when supply was tight. It's not manageable when supply rises. When new listings outpace new households, inventory doesn't just increase, it accumulates. And accumulation changes psychology. Psychology drives housing more than fundamentals admit. When buyers believe prices will rise, they rush. When they believe prices might stall, they wait. Waiting is inventory's best friend. You can see this in the data. Maury homes staying on the market past 30 days. Maury past 60. Maury past 90. These homes don't disappear. They linger. And lingering inventory becomes a signal. Here's the historical pattern. Inventory rises first. Sales slow second. Prices respond last. Always. The Northeast is still early in this sequence, which is why many people don't believe it yet. But belief doesn't move markets. Supply does. Another critical factor, construction pipelines. Remember the approvals after 2020. Those units are arriving now, especially multifamily, especially near transit hubs, especially in secondary cities. These homes were planned in optimism. They're being delivered into caution. That mismatch matters. And here where power shifts again. Renters gain options. Landlords compete. Rent growth slows. When rent growth slows, investor demand weakens further, which feeds inventory again. This is not a crash loop. It's a pressure loop. Slow, persistent, relentless. Some markets will resist longer. Prime neighborhoods, top school districts, unique properties. But even strong areas feel inventory pressure eventually. Because buyers compare. And comparison kills pricing power. So who feels this first? Condos before houses. Luxury before entry-level. Secondary suburbs before core neighborhoods. This pattern is already visible. And the biggest mistake sellers make at this stage. Assuming time is on their side. Time favors buyers when inventory rises. Always. We'll explore how sellers are responding, why price cuts are becoming contagious, and the exact moment inventory stops being manageable and becomes dangerous. Because markets don't break when people panic. They break when confidence quietly leaves the room. Markets don't turn when prices fall. They turn when sellers realize they're no longer in charge. That moment doesn't make headlines. It doesn't trend. It just spreads. Quietly. At first, sellers deny it. They blame the season. They blame interest rates. They blame buyers for being picky. Anything except the truth. Inventory has changed the balance. In the early stage, sellers test the market. They list high. They wait. They expect negotiation to come to them. Sometimes it does. But more often now, it doesn't. Weeks pass. Showings slow. Feedback turns vague. Nice house, but. Good location, but. We are still looking. That's inventory speaking. Then comes the first price cut. Not dramatic. Just enough to refresh the listing. 5%. Maybe less. Sellers don't see it as a concession. They see it as strategy. But buyers see it differently. Buyers see weakness. They start tracking reductions. They compare histories. They wait for the next cut. Because inventory teaches patience. This is how price cuts become contagious. One seller adjusts. Then another. Then a neighbor. Suddenly, reductions feel normal. And when reductions feel normal, pricing power disappears. Here's the dangerous part. Price cuts don't always bring buyers back. Sometimes they confirm buyer fear. What does the seller know that I do? Will this be cheaper in 3 months? Why rush? Inventory creates questions. Questions slow decisions. Historically, the Northeast responds to pressure differently than boom and bust markets. It doesn't crash fast. It grinds. Listings sit. Prices drift. Real values erode quietly. This is how owners lose money without feeling like they did. Now add one more factor. Carrying costs. Higher interest rates changed seller behavior. Many homeowners locked in low mortgages years ago. They don't need to sell, but they want to. That makes them stubborn at first. But carrying a vacant home isn't free. Taxes, insurance, maintenance. Every month hurts a little more. Inventory turns patience into pressure. Then reality arrives. Life changes. Job transfers. Divorce. Retirement. Inheritance. These sellers don't have the luxury of waiting. They cut. And forced sellers set the market. Always. This is the moment when inventory becomes dangerous. Not when listings rise, but when sellers compete. Competition shifts the entire psychology of the market. Buyers feel safer waiting. Agents push for realism. Appraisals come in lower. Lower appraisals kill deals. Killed deals create relistings. Relistings inflate inventory. The loop tightens. We saw this before. Early 1990s, Northeast. Mid-2000s, select metros. Post-COVID, urban condos. Different eras. Same mechanics. Inventory leads. Confidence follows. There's another quiet signal. Rent concessions. When landlords offer incentives, it means supply is winning. Free months. Reduced deposits. Flexible leases. These don't stay isolated. They ripple. Lower rents reduce investor appetite. Reduced investor appetite increases listings. Inventory doesn't care whether it's owned or rented. Supply is supply. Now think about buyers. Buyers aren't emotional right now. They're analytical. They run numbers. They stress test payments. They assume rates stay high. That mindset changes everything. When buyers think like investors, sellers lose leverage. And here's the part few talk about. Media narratives lag reality. By the time headlines admit inventory is a problem, the shift is already advanced. The Northeast is still in the confusion phase. Mixed signals, contradictory stories. That's always the middle. Strong sellers still win. Perfect homes, perfect locations, perfect pricing. But average homes struggle first. Inventory punishes the middle. And once the middle cracks, comps follow. Comps are the backbone of pricing. When comps soften, optimism breaks. This is why inventory matters more than rates. Rates can change quickly. Inventory cannot. Once supply is built, listed, and competing, it doesn't vanish overnight. It has momentum. Housing markets don't end with a bang. They end with silence. No breaking news. No dramatic collapse. Just a slow realization that the old rules no longer apply. That's where the Northeast is heading now. Inventory doesn't destroy markets. It reshapes them. It decides who has leverage, who waits, and who adapts. And in this phase, adaptation is everything. Some sellers will adjust early. They price realistically. They accept negotiation. They move on. These sellers will do fine. Not because the market saved them, but because they understood it. Others will wait. They'll anchor to peak prices. They'll reject offers that would have cleared the market months earlier. They'll assume conditions will come back. Some of them will still sell. Just later. And cheaper. This is how a market resets without crashing. Prices don't collapse. They stagnate. Nominal values drift sideways. Inflation erodes real value. Time becomes the correction. This is the Northeast's signature move. Buyers, meanwhile, gain something rare. Optionality. They can choose. They can negotiate. They can walk away. That doesn't mean every deal is a bargain. It means the fear is gone. And when fear disappears, rational pricing returns. First-time buyers benefit the most. They don't have equity illusions. They don't chase past highs. They buy based on payment and lifestyle. Inventory gives them breathing room. Investors become selective. No more "it'll rent anyway" logic. No more thin margins. Only strong locations. Only durable demand. That restraint is healthy. It prevents bubbles from reforming too fast. Renters gain leverage too. More options. More concessions. More flexibility. Which feeds back into ownership demand. Everything connects. Now look ahead. What would reverse this? Lower rates could help, but only partially. Stronger job growth could stabilize demand, but not erase supply. A sudden population surge is unlikely. Inventory doesn't disappear easily. It works through the system. The Northeast doesn't need a crash to reset. It just needs time. Time for listings to clear. Time for expectations to adjust. Time for prices to mean something again. This is not a housing apocalypse. It's a normalization, a return to balance. And balance always feels uncomfortable to those used to advantage. The people who understand this phase early gain the most. They don't rush. They don't panic. They don't cling to narratives. They read the market. And the market is saying one thing clearly now. Scarcity is no longer guaranteed. Inventory is back. And with it, power is changing hands.